All right, so we're going to look at a trade setup. This is a 112 in CL. This is oil futures options, and we are looking at 86 DTE. That's what it is now. Um, we can take a look and see that I filled this trade on Feb 19, which was yesterday. Markets were kind of closed half day, so I didn't get a chance to push this out. But what I will do is set up the same exact trade for those that want to maybe follow along or follow the process to see how these trades are going to evolve over time. So I got a fill in this trade for 36-cent credit. Right now, this trade is going for 39 cents. So you will be getting slightly higher credit if you follow along into this trade. This is what the risk profile for this trade looks like. So we're taking in, say we get a fill for 39 cents, taking in $390. This trade takes up about $3,500 in span margin account. And this trade has 86 days until expiration. So now, potential outcomes here are the underlying is somewhere above the long leg of the put debit spread, which is at 75. So anything 75 or higher, we keep, let's just round this off to $40 credit up front, which translates to $400 per one unit, right? 112 is a unit. So we take in the $400 credit. If the underlying expires above 75, we get to keep the $400. If the underlying is somewhere between 74 and 59, this will be the bear trap profit, which is the width of this put debit spread, which is 1 point or $1,000, plus the $400 that we collect up front. So in the trap, we can make $1,400. And then the outcome nobody wants to think about is that if the underlying goes down below 59 is where our two naked puts are, this trade is going to be in a lot of trouble. So to avoid the trouble, I like to use about a 1x max profit, which is in the trap, as my stop loss. So if the most I can possibly make here is $1,400, I would look to stop out of this trade when I am down $1,400. With CL, it's not my favorite kind of a setup for a stop loss. The reason being is because, and this has a lot to do with the skew and the option pricing in this particular vehicle. But you can see that the T plus zero line dives way, way down as soon as we enter the trap. And the deeper we go in the trap, my T plus zero line is really sloping downwards. And, the underlying could go down as low as, let's call this maybe 69, right? From 77, where we are right now. And this trade is going to be at a point where I would need to stop out. Even though, if you think about this, right, we are not even halfway into the trap. But if we do get down to about 69 level on oil, this trade is going to be at a point where it needs to get stopped out. So maybe to delay a stop out, if we start to push into the trap early on in the trade, I may use some sort of delta hedging technique to kind of bend the T plus zero line a little bit to flatten it out and to kind of see if we get some sort of reversion or a bounce. And if the underlying will continue to move lower, if I bend my T plus zero line, let me see if I can maybe draw this. If I take my T plus zero line from sloping downwards and I flatten it out, something like this, right? Hopefully it's not going to be as saggy, but if I get my T plus zero line to kind of slope upwards once we pass maybe 70. So from here, something like this, then um, me getting stopped out is going it could happen over time, but if the underlying continues to push lower, you see my T plus zero is now sloping upwards, which means that I'm not going to hit my minus 1400 PNL on this trade, unless volatility rises and a few other things have to take place. But the idea is on the way down, to delay my stop, I may bring in some long premium trades, such as put debit spreads, maybe buy some naked long puts, just to buy myself some time to see if the underlying is just pushing into the trap for a bit, and then we get a reversion back to the upside. So with that said, this is the trade setup. I am buying to open. This is the put debit spread 75.74, 88 DTE. And I am selling 2 of the 59 puts naked for every 1 put debit spread. And this should yield about a 40-cent credit up front. And I am going to add this trade to a campaign. I think I'm going to do these 112s in CL maybe every week, early in the week, Monday or Tuesday, maybe every other week. It all depends. We can quickly look at, right, for this trade takes up about $3,500 in margin, but we also have to stress test our positions, and I already have one position in CL, and I have another one that I put on yesterday. So if we could uncheck this and check everything else. So this is what 2 of my positions in CL look like. They take up about $5,500 of margin, which is not a big deal, right? You have to pay attention to how much buying power you have available and how much more you can allocate to it. But if we look at a stress test, and again, I'm not anywhere near a point where I can't put any more trades on, but I will continue to put trades on until I run up against I'm out of buying power for new trades and I have to wait for some of the older trades to come off. Or I'm at a point where I have plenty of buying power, but my stress test, and if we take CL and we go -3 EPR, which is expected price range, -3 EPR, P&L on the day reading cannot exceed 2x your net lick. If this number minus 14,000, so let's say you have a $5,000 account, if your reading is minus $14,631, you cannot take any more trades in CL. Doesn't matter how much buying power you have. So I'm going to look at both numbers, buying power available and where my -3 EPR on P&L on the day. I'm going to try to put on as many trades as I can. And as some of the older trades will start to come off, I'll just keep these trades in rotation. So this is the trade. And if you didn't want to take this trade, and if you wanted to take a trade similar to what I took yesterday, price is not that much different. It's only 3 or 4 cents difference. You can try to maybe move the put debit spread down a half a point. So and this one is showing 43 cents. So I don't think the problem is in the put debit spread. I think the issue is with the naked puts. Maybe you can move this one. There you go. If you move the naked puts from 59 down to 58.5, right, you increase your probability of profit just a little bit, right? Because now your naked puts are half a point further out of the money. And since your naked puts are half a point further out of the money, you just take a little bit less credit up front. I would probably just keep it simple and sell the 59, try to take in the 40-cent credit, and from there, just follow the plan for this trade.